When it comes to investing as a beginner, a few things need to be set in stone. First off, single stock picking for a beginner investor can be risky, and please take that advice from someone like myself that made tons of huge mistakes very early on in my investing journey. Also, ETFs or exchange traded funds are a perfect way for beginner investors to have exposure to a larger group of stocks without having to bet all their money on a single name. Now in this video, we're going to go over what I think could be the perfect one-size-fits-all ETF for pretty much any beginner investor out there who wants exposure to dividends, but also wants exposure to massive growth. So make sure to stick around, drop a like down below, and subscribe, and let's get into it. Now in order for an ETF to be called the one-size-fits-all ETF, it's going to need to have all of the following things. It's going to first off need to have historical growth in ETF share price. It's also going to need to pay dividends and have a history of paying dividends consistently. And also very important, it's going to need to have dividend growth because let's be real here, we are all going to need to earn more and more income in the future off of our investments in order to keep up with inflation alone. And lastly, it's going to need to have a very, very cheap expense ratio. Now, although there might be other ETFs across the market that do offer all those things and maybe more, right here, the SCHD ETF or the Schwab US Dividend Equity ETF is what I have found to be the perfect match. Now this ETF has a very simple objective. It's to track as closely as possible before fees and expenses the total return of the Dow Jones US Dividend 100 Index, and we are going to go deeper into this index in a minute here. Also some highlights: a straightforward low-cost fund offering potential tax efficiency. The fund can serve as part or the core of a complement in a diversified portfolio. Now this fund tracks an index focused on quality and sustainability in dividends, which is also very important. And it invests in stocks selected for fundamental strength relative to their peers based on financial ratios. Now, a second ago, I mentioned that if we want to choose an ETF to be sort of a one-size-fits-all, it's going to need to have multiple different attributes. The first thing that I said is it's going to need to have historical growth over time because as beginner investors, you're going to want to invest into a vehicle that has historical proof of growing and compounding consistently over multiple different time frames. Now, the SCHD ETF has done exactly that. Since around 10 years ago in 2014 or so, this ETF has almost doubled. And as of right now, the ETF is actually down quite a bit, which means it could potentially be a good buying opportunity for investors out there that are willing to weather the storm that we're currently going through and that have a longer time horizon. But SCHD is currently trading around $70 per share. And even with that being said, on the max time frame, this ETF is up 171.59%, and that's not including dividends. Now, even though ETF growth is of course very important, also very important, maybe even equally as important, is the actual ETF holding breakdowns, which stocks are going to be within the ETF, and if or if not these companies are strong. Now, like I said earlier, there are going to be plenty of ETFs out there with really high quality holdings, but again, for this ETF in specific, it really crosses off everything that I would consider a perfect one-size-fits-all for most investors out there. Now, the holding breakdowns are mostly made up of industrials at 17%. Then next comes healthcare, financials, consumer defensive technology, energy, consumer cyclical, communication, basic material, and utilities. So this ETF is highly diversified with around 100 different holdings, some of the top companies being things like Amgen, AbbVie, Pepsi, Merck, Chevron, Coca-Cola, Verizon, Texas Instruments, Pfizer, and Broadcom. Familiar companies that have been around for a while, that have been paying dividends and raising their dividends pretty consistently over time, and companies that are overall pretty stable. Now, because the SCHD ETF's objective is to track as closely as possible before fees and expenses the total return of the Dow Jones US Dividend 100 Index. Looking right here at the Dow Jones US Dividend 100 Index methodology, this right here basically explains exactly how stocks are either added or taken out of the Dow Jones US Dividend 100 Index or the index that SCHD tracks. Now, this is a pretty sophisticated process, and because of the screening process, it makes it really tough for stocks to even be qualified to enter the index to begin with. To enter this index, stocks must pass the following screens. Things like minimum of 10 consecutive years of dividend payments, minimum FMC of US 500 million, minimum 3-month ADVT of US 2 million. Now, there's all sorts of other different screenings that stocks need to have or need to pass in order to be qualified to be entered into the index. And if you want me to break this all down in a more in-depth video, definitely comment down below and let me know, and I will do so. Now, one of the other main points of criteria we talked about is that If you want to find a one-size-fits-all ETF for most investors, we're going to hope that this ETF has a low expense ratio. So an expense ratio is just a small fee basically for owning the ETF, and with SCHD having a 0.06% expense ratio, it's basically so small that you're probably not even going to notice it that much, unless your holdings becomes absolutely massive, which then I think that's sort of a good problem to have. Now, another thing that's obviously very important for most investors out there, especially for investors that want cash flow along the way along their investing journey, to use the cash flow for either some bills or living expenses or whatever, or maybe to use the cash flow like I personally do, to reinvest into more shares of things like SCHD, or maybe even other ETFs or other stocks across the market. So dividends, in my opinion, are very important, and they are important to many investors out there. So SCHD has a trailing 12-month dividend yield of 3.66%, which is relatively very high considering the amount of growth that this ETF has had. But maybe even more importantly, and another very important aspect of picking a one-size-fits-all ETF is the dividend growth rate. So the dividend growth rate is basically how much a dividend has grown over the last 12 or so months, and SCHD has had a 5.7% trailing 12-month dividend growth rate, which means the dividend has grown quite a bit just over the last 12 months. But keep in mind, if you zoom out a little bit, SCHD has had 11.44% over the last 3 years. Over the last 5 years, 13.69% dividend growth, which is absolutely outstanding, and an 11.11% over the last 10 years. Now, to see this a little bit more visually, let's look at SCHD's dividends that the ETF has paid historically. So to give you an idea, back in 2011, this ETF was paying 12 cents per share per quarter. The next quarter after that was around 14 cents per share per quarter. Then it bumped up quite a bit to 21 cents per share per quarter. Around 10 years ago, SCHD was paying anywhere from around 23 to maybe 25 cents per share per quarter. Fast forward 10 or so years, now this ETF is on a consistent basis, paying 50, 60, 70 cents almost per share every single quarter, which means that investors that have been holding onto this ETF, in theory for the last 10, 11, 12 years, are now getting paid almost 3 times as much on a consistent basis quarterly. Now you might be asking, well, why is dividend growth so important to me, and why is that really a metric to pay attention to? I think for one, an obvious reason is the fact that inflation has been very, very high over the past few years, so it's given us a really honest look at what potentially could happen in the future. And if inflation is anywhere from say 2 to 3 to 4 to 5% per year, this means that if you own an asset that's continuously paying you more and more in dividends, you will most likely, at least in theory, be okay, because the cash flow that you're getting paid consistently is going to at least somewhat stay with or hopefully beat the rate of inflation. But it's not just inflation that makes the dividend growth rate of an investment so important, and specifically in the case for SCHD on why I think the dividend growth rate is crucial when buying the ETF. If we look at a dividend calculator and start with just $25,000 and add $12,000 per year, have DRIP turned on, and have an initial starting dividend yield of 3.5% and an expected annual dividend amount increase of 8%. Now, even though SCHD could have a higher or lower expected annual dividend amount increase, just going with 8% just to be safe. Now, if we were to invest this relatively small amount of money for 30 years, look at what happens over time. Now, before we go ahead and calculate all this and see what numbers we would get from now until 30 years, we have to understand exactly what's going on here. The power of compound interest is what's happening. Now, compound interest is the interest on savings calculated on both the initial principal and the accumulated interest, or in this case, dividends from a previous period. As the investor continues to buy more and more shares of SCHD, along with reinvesting all the dividends that were being paid from the previous year, the power of compounding is really going to take place, and the dividend snowball is going to get bigger and bigger. The SCHD investment would start at $25,000 and offer around $886 per year in dividends. Now remember, this investor is going to be consistently contributing to the portfolio and is also going to be reinvesting their dividends. So the compounding effect is really going to take place. So much so by year number 10, this investment that started with just $25,000, an additional $1,000 per month, and dividends reinvested is already up almost to $190,000 and over $10,000 per year in dividends. Now by year number 20, a little bit further down, $623,000 in principal and already $55,000 plus per year in dividends. And by year number 30, especially for the younger investors out there that definitely have some time on their side, by 30 years in, $2.25 million with over $328,000 per year in dividends. So there we have it. There's what I think, in my opinion, is the one-stop, one-size-fits-all, perfect dividend growth ETF for most beginner long-term investors out there. Now, like I mentioned earlier, there's definitely other ETFs that are super high quality that also cross off most of, if not all of my criteria of things like growth historically, dividends being paid, dividend growth rate, a strong basket of holdings, and a low expense ratio. And although those are just a few of the metrics I like to go off of to keep things simple, there's definitely more things you can look into, like the actual makeup of the underlying index, like I sort of mentioned earlier. But that being said, for me, SCHD has been a foundational part of my overall long-term dividend growth portfolio for years now, and I'm continuing to add shares like crazy, especially while the price has been beat up like it has as of recently. But in the conversation of a one-size-fits-all, best long-term ETF for most beginners to invest into, if you could only choose one ETF to pretty much cross off all the criteria we're talking about, which ETF would it be and why? Please comment down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more featured content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.